Hello, XRP Army, and welcome back to the Crypto Public, your go-to channel for the latest tiny updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Public, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, something just happened in Japan that has never happened before in the recorded history of its modern financial markets. For the first time ever, Japan's 10-year government bond yield surged above 2.8%. Now, on the surface, that sounds like a dry economic statistic, a bond yield, a central bank issue, something that belongs in a Bloomberg terminal, not a crypto portfolio. But underneath that headline is a chain reaction powerful enough to hit every major asset class on Earth: stocks, real estate, treasury, markets, and yes, XRP, the anointed one, because hidden underneath global markets is one of the largest financial mechanisms ever created, a mechanism built on decades of cheap Japanese money. And right now, cracks are beginning to appear. But while short-term fear is spreading across markets, something else is happening beneath the surface: a structural shift, a migration of global finance itself. And if you understand the difference between temporary panic and long-term transformation, you may understand why some investors believe the next decade of crypto could look nothing like the last one. Ladies and gentlemen, to understand why Japan suddenly matters to XRP holders, we need to zoom out, way out, because global markets are not driven only by company earnings, crypto narratives, or social media hype. They are driven by liquidity, capital flows, debt, interest rates, and the movement of money between nations. And for decades, one country quietly became the fuel source for global speculation: Japan. For nearly 30 years, Japan operated under economic reality unlike almost any other major economy. Near zero interest rates, ultra-loose monetary policy, and eventually negative rates. The Bank of Japan kept borrowing costs so low that global investors realized they could effectively borrow Japanese yen for almost nothing. And once they borrowed that money, they could move it elsewhere. This became known as the yen carry trade. The mechanism is simple: borrow cheap yen, convert it into dollars, invest in higher yielding assets, pocket the difference, rinse and repeat. That difference became one of the most profitable trades in global finance. And over time, the scale became enormous: trillions of dollars, U.S. equities, emerging markets, corporate debt, private equity, technology stocks, crypto, all indirectly supported by the availability of cheap Japanese capital. Now, this is what most people miss. When liquidity enters markets consistently for years, people begin assuming asset prices naturally go up. But often, what they're actually seeing is leverage, and leverage works beautifully on the way up until conditions change. Then suddenly, the same force that pushed markets higher begins pulling them downward, and that is where we are now. When Japanese bond yields rise, borrowing money in Japan becomes more expensive. That sounds small, but in leverage systems, small changes create massive consequences. Because once borrowing costs rise high enough, investors running the carry trade face a serious problem. The math starts working. If Japanese rates rise while U.S. assets weaken, the spread disappears. And when the spread disappears, investors begin unwinding positions. That means selling assets: stocks, bonds, commodities, cryptos. Ladies and gentlemen, write this down. This is an explanation that you need to understand, because at the end of this video, we're going to go into how this is playing out right now and what's happening now. Anything liquid enough to exit quickly. This is called the reverse carry trade. And historically, when large carry trades unwind rapidly, volatility spreads everywhere. A real historical example of this happened during the 1998 long-term capital management crisis. LTCM was one of the most sophisticated hedge funds in the world, built by elite Wall Street traders and Nobel Prize-winning economists. The fund used massive leverage across global markets under the assumption that correlations and spreads would behave predictably. But when volatility surged following Russia's debt default, positions that seemed mathematically safe began collapsing simultaneously. The unwinding became so dangerous that the Federal Reserve organized a rescue to stabilize the financial system. Write that down, let that sink in. Massive. Why does that matter today, you're asking? Because leverage systems always appear stable until liquidity conditions change. and Japan's yield surge suggests liquidity conditions may be changing. Now combine that with another issue, sticky inflation in the United States. If inflation remains elevated, the Federal Reserve may keep rates higher for longer. Higher rates increase the attractiveness of safer yield-bearing assets. And historically, that pressures speculative assets. That is why markets reacted so aggressively. Bitcoin sold off, Ethereum dropped sharply, risk appetite weakened because price is reacting, but the system itself is evolving. And those are not the same thing. You have to really pay attention to this. This distinction is critical. Short-term noise, long-term structure, ladies and gentlemen. I always say that. Those are two completely different forces. Short-term noise is driven by liquidity shocks, fear, macro headlines, rate expectations, volatility. Long-term structure is driven by adoption, infrastructure, regulation, technology integration, institutional behavior. And right now, the short-term environment is noisy, very noisy. But beneath the noise, structural shifts continue moving forward. The XRP ledger did not become slow because Japan's bond yields rose. Cross-border payment demand did not disappear because inflation data came in hot. Tokenization development did not stop because hedge funds reduced exposure. The infrastructure build-out continues, quietly, systematically, globally. And historically, transformational systems often advance during periods when public sentiment is weakest. The second historical example comes from the early railroad expansion in 19th century America. Railroad companies experienced violent crashes, bankruptcies, and speculative bubbles. Entire fortunes were wiped out during panics. But despite those crashes, the rail infrastructure itself continued expanding. And eventually the railroad network transformed commerce, industry, shipping, banking, and economic growth permanently. The investors who survived the volatility and recognized the structural trend benefited enormously. Not because there was no chaos, but because they understood the difference between temporary financial instability and long-term technological adoption. That distinction matters today, because crypto investors often confuse price action with progress. They are not always the same thing. Sometimes the most important infrastructure developments happen while prices are falling. And that brings us directly to XRP. Ladies and gentlemen, one of the largest obstacles for institutional crypto adoption has always been regulatory uncertainty. Large institutions do not move billions of dollars based on vibes. They require legal clarity, compliance standards, defined jurisdictions, operational certainty. And for years, that uncertainty slowed institutional involvement in digital assets, especially in the United States. But here's where things get interesting. Momentum around digital asset legislation has accelerated dramatically, particularly surrounding market structure frameworks and token classification. The conversation is no longer whether blockchain technology matters. The conversation now is how governments intend to regulate and integrate it. And XRP occupies a very unusual position inside that conversation. Unlike many digital assets, XRP has already gone through one of the largest regulatory battles in crypto history. The SEC lawsuit became a defining moment for the industry, and while the legal process created years of uncertainty, it also produced something important: judicial analysis, legal precedent, and a framework institutions can evaluate. Some analysts believe future legislation could further solidify distinctions between commodities, securities, and utility-based digital assets. If that happens, institutions that previously remained cautious may become far more comfortable participating in the ecosystem. Now, this does not mean overnight adoption, and it certainly does not guarantee price outcomes. But regulatory clarity changes institutional psychology, and institutional psychology moves markets. Once compliance risk decreases, entirely new categories of capital become available: pension funds, banks, asset managers, payment providers, treasury operations. That is where structural demand begins forming, not from retail excitement, from institutional integration. Now let's talk about one of the biggest shifts happening in finance today: tokenization. This may become one of the most important financial developments of the next decade, because traditional finance still operates on infrastructure built generations ago. Settlement delays, intermediaries, reconciliation layers, operational friction. Most people assume when they buy or sell financial assets, everything settles instantly. In reality, many systems still require multiple parties and delayed final settlement. Blockchain changes that. Tokenized assets can move faster, operate continuously, reduce settlement friction, and potentially lower operational costs. And institutions are paying attention. The Depository Trust and Clearing Corporation, the DTCC, processes staggering amounts of financial activity annually, The scale is almost impossible to comprehend, which is why tokenization discussions surrounding large financial institutions matter so much. Even limited integration of blockchain infrastructure into settlement systems could reshape global finance. Now, this is important. There is a massive difference between speculation and infrastructure adoption. Speculation creates temporary hype. Infrastructure adoption creates recurring utility. And some analysts believe utility-focused digital assets could benefit disproportionately if tokenized settlement expands globally. That includes assets focused on interoperability and cross-border movement, which is why XRP continues appearing in institutional discussions, not because of memes, not because of social media excitement, but because the financial industry cares deeply about speed, cost, efficiency, and interoperability. Those are operational problems, and operational problems attract institutional spending. Ladies and gentlemen, for decades, institutional payments have operated throughout corresponding banking networks. And one of the central institutions coordinating global messaging has been SWIFT. SWIFT itself is not money, it's a messaging infrastructure. But the global payment system built around it remains slow and fragmented. Cross-border settlement can involve multiple intermediaries, different banking systems, currency conversion layers, compliance checks, settlement delays. This creates cost. And where there's inefficiency, innovation eventually arrives. Now, this is where the modern system begins resembling one of history's great transitions. The first historical analogy is the shift from sail-powered trade routes to steam-powered shipping during the Industrial Revolution. At first, many believed the existing system was good enough. Ports were already established, trade already functioned, but steam technology dramatically increased speed, reliability, and scalability. And once global commerce recognized the advantage, the old system slowly became structurally outdated. The comparison to cross-border finance is difficult to ignore, ladies and gentlemen. Legacy settlement systems still dominate, but financial institutions are increasingly exploring faster digital alternatives. Ripple's payment-focused infrastructure continues positioning itself within that discussion. And while there remains debate about the extent of future adoption, the broader direction of financial modernization appears undeniable. Governments are exploring CBDCs. Banks are testing blockchain settlement. Cross-border payment pilots are expanding. The system is evolving, even while markets panic over short-term volatility. That distinction matters enormously because markets often focus on quarterly price action while institutions focus on decade-long infrastructure trends. And institutions think very differently than retail investors ask, what pumps next week? Institutions ask, what infrastructure will dominate transaction flow over the next 20 years? Those are very different questions, ladies and gentlemen. Another reason macro developments matter so much right now is because the world appears to be entering a new monetary era. Debt levels are enormous. Interest rate dynamics are changing. Geopolitical fragmentation is increasing. And central banks globally are experimenting with digital infrastructure. That includes stablecoins, CBDCs, tokenized deposits, and interoperable payment systems. Some analysts believe the next phase of finance will involve hybrid systems. Traditional banking layered with blockchain settlement, not total replacement, integration. And if that becomes reality, interoperability becomes incredibly valuable because different systems must communicate, different currencies, different jurisdictions, different regulatory environments. Interoperability is not exciting on social media, but it's critically important to institutions. And XRP's long-standing positioning around cross-border interoperability keeps it relevant inside these conversations. Now, this is where many investors become confused. They assume adoption must look explosive, sudden, immediate. But major infrastructure transitions rarely happen that way. Banks move carefully. Governments move slowly. Compliance frameworks takes years. Adoption often appears invisible until suddenly it becomes obvious. The internet itself followed that pattern. For years, it seemed experimental, niche, unimportant. Then one day the world realized everything had already changed. Financial infrastructure may follow a similar path. And that's why macro events like Japanese bond yields matter. Because while short-term financial stress creates volatility, it also accelerates pressure for more efficient systems. Periods of instability often force innovation. Now let's talk about something most finance channels avoid, the emotional side of investing, because understanding macroeconomics is important, but surviving volatility psychology is equally important. Every investor says they want opportunity. Very few want the uncertainty that comes with it. And crypto amplifies that emotional pressure dramatically. Price swings violently. Headlines change hourly. Narratives reverse overnight. One day institutions are bullish. The next day markets collapse over inflation fears. And that environment creates exhaustion. especially for long-term holders. Now, that is what most people miss. The market constantly tests conviction before major moves. Historically, large price expansions often occur after long periods of frustration, doubt, and volatility. Because markets are emotional systems, fear creates selling pressure, patience becomes rare, and rare behavior often becomes disproportionately rewarded. That does not mean every thesis succeeds. It does not mean every project wins, but it does mean emotional discipline matters a lot. The second historical analogy comes from ancient Roman road systems. When Rome began building interconnected roads across its empire, many regions initially saw little immediate benefit. The projects were expensive, slow, difficult, but over time, those roads transformed military logistics, trade, communication, and economic coordination across enormous distances. The infrastructure became more valuable than most people initially understood. Modern financial rails may follow a similar pattern. At first, the infrastructure build-out appears technical and boring, then eventually the entire system begins depending on it. That possibility is exactly what investors continue watching blockchain settlement technology so closely. So where does that leave us? In short term, volatility could absolutely continue. If Japanese yield continues rising and carry trades unwind further, risk assets may remain under pressure. If inflation stays elevated, central banks may keep financial conditions tighter, and tighter liquidity historically creates turbulence for speculative markets. That is reality. But here's the other side of the equation. Structural adoption trends continue advancing. Tokenization, digital settlement, institutional blockchain, infrastructure, cross-border modernization, regulatory development. Those trends have not disappeared. If anything, they are accelerating. And this creates a fascinating environment because financial markets may be entering a period where short-term liquidity conditions remain unstable, while long-term infrastructure transformation continues gaining momentum. That tension could define the next phase of digital assets. Some projects may fade, some narratives may collapse, but infrastructure-focused systems with institutional relevance may continue attracting attention, especially if global finance increasingly prioritizes efficiency, interoperability, and tokenized settlement. None of this guarantees outcomes. No one can promise price targets. No one can predict exact timelines. But serious investors watch structure, and structurally, the global financial system appears to be changing. Let's bring everything together now. Japan's bond yield surge is not just a local economic story. It's a signal that the era of ultra-cheap global liquidity may be shifting. And when liquidity shifts, every asset class feels it. That includes crypto. In the short term, that can create fear, selling, volatility, forced unwinds. But short-term price movement and long-term infrastructure evolution are not the same thing. And beneath the volatility, a much larger transformation appears to be unfolding. Governments are exploring digital currencies. Banks are testing blockchain settlement. Institutions are investing in tokenization. Regulators are building frameworks. The architecture of global finance is evolving in real time. And XRP remains one of the few digital assets consistently positioned within conversations around interoperability, payments, institutional settlement. That does not guarantee dominance, but it does explain why investors continue paying attention. Because the real opportunity may not be about hype cycles. It may be about infrastructure, and infrastructure changes the world slowly, then suddenly. The internet did that. Railroads did. Global shipping did. Financial settlement systems may be next. And that is why understanding macro and economics matters. Because when you understand how liquidity, regulation, institutional adoption, and infrastructure evolution interact, market volatility starts looking very different. Instead of random chaos, you begin seeing transition. Messy, complicated, uncertain, but transformational. Right now, the market's focused on fear, Japan, inflation, interest rates, liquidity stress. And yes, those forces matter. They could continue creating pressure across global markets. But while price reacts to short-term uncertainty, the system itself continues evolving underneath. That is the critical distinction. Short-term noise, long-term structure. Always pay attention to what's quiet, ladies and gentlemen. The investors who understand the difference historically position themselves very differently than everyone else, not because they can predict the future perfectly, but because they recognize when infrastructure transitions are underway. And whether XRP ultimately becomes a dominant piece of that future or simply part of a broader blockchain ecosystem, the larger transformation appears increasingly difficult to ignore. Global finance is changing. The only real question is how fast it does. If you found value in this breakdown, hit the like button, subscribe. And in the comments below, tell us this. Do you think the current volatility is temporary macro noise or the beginning of something much bigger for global markets? Because the next few years may define the future of financial infrastructure itself. And the people paying attention are the people most prepared for what comes next, ladies and gentlemen. The larger financial system may already be slowly repositioning underneath them. Short-term noise, long-term structure. Prices reacting, the system's evolving. Ladies and gentlemen, if you enjoy the satellite perspective that we give, do subscribe, like, and join the Wolf Pack, because we track the macro shifts, the institutional signals, and the structural changes most people overlook from the perception of a floor trader. Always do your own research. Never invest based solely on a YouTube video. And remember, always remember, pay attention to what's quiet. Short-term noise, long-term structure. I say this over and over again. I'll see you in the next one. Hope everyone's having a happy Memorial Day, ladies and gentlemen. A couple quick things to go over here real fast. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel, and everyone else who's still here watching Memorial Day. Remember, freedom isn't free. Again, everyone is watching the Kabuki theater about peace or continued conflict in the Middle East. If there's peace, that has one set of circumstances for oil and gold. If there's continued kinetic activity, that has a total another. We've gone over all of these very in detail. Everybody knows the relationships who's been here. If oil drops, gold goes one way. If oil rises, gold goes the other way. Affects the DXY. We go over all these things. But I want to talk about what I think is the major thing that nobody's paying attention to right now. And this is something that we think is very, very important right now. Again, this is very, very important. Ladies and gentlemen, the world is entering into a very rare circumstance. We made a video today about the Japanese yen because I wanted to hit home about what we think is really important, what's happening. Because the current global bond sell-off, ladies and gentlemen, to me, resembles the dangerous historical turning points like 2007, and potentially 1987. So what that really looks like in English, as I take the PhD out of PhD, is rapidly rising long-term yields could ultimately break the U.S. economy and equity markets, just as prior liquidity-driven cycles ended in crisis. Write that down. This is very important. Everybody talks about carry trades, reverse carry trades. On the first other video I made, I told you the first house I bought, I made one trade on the carry trade, and I bought my first home. I'll never forget that. But everybody talks about carry trades, and I really highly doubt half the people that talk about them have ever used it to make any money. It's one thing to talk about something. It's another thing to have actually used it to make money. Again, the competition is with your bank account, with nothing else. But I want you to understand this so you understand why we're doing this. It's very important. Why I say why we're doing this is Japan is the key systematic risk. As surging Japanese bond yields, the unwind of decades of QE, rising inflation expectation, and a weakening yen despite higher rates are signs of an emerging debt crisis that could spill into global bond and equity markets. Ladies and gentlemen, I'm trying to take the PhD here out of PhD so that you can understand this. Again, sharp moves in the UK gilts and the US Treasuries are arguing markets may be underestimating how quickly higher real yields and tighter liquidity conditions can destabilize asset prices, particularly after years of dependence on cheap money and central bank support. Ladies and gentlemen, most amateur macro analysts right now, they're drawing comparisons to either 1999 or 2008. They're all converging around the same narrative traders have been hearing for the last month or so. Again, ladies and gentlemen, I've been saying this for a while as well. We pay attention to the widowmaker when Japan opens. Our Singapore office pays attention to all of this, and that's the most important thing. Because, ladies and gentlemen, when you understand the dynamics of Japanese monetary systems and devaluations and sovereign debt, this gives you an edge. Again, and we think the global bond market's entering a phase more comparable to 2007, 2008 than 1999. And that's very important. Why I say 2007, 2008 than 1999. The distinction matters because it's not primarily about equity valuations or tech exuberance. It's about bond market itself beginning to fracture under the weight of decades of artificial monetary suppression. So if you look at long-term yields, they're surging globally. That threatens equities, liquidity, refinancing conditions, and ultimately economic stability. This starts with Japan. Japan was effectively the laboratory for modern monetary experimentation. I told you, I bought my first home with a carry trade. I'll never forget, one trade, I bought a home. So if you look at quantitative easing, yield curve control, near zero negative interest rate policy, persistent sovereign debt, monetization, ladies and gentlemen, The United States didn't go as far as Japan, and at least not yet, but it followed the same trajectory structurally with money printing. I always go over, if it didn't work with them, how's it going to work with us? When the UK did this, and a big shout out to all of our Wolfpack members in the United Kingdom, when the United Kingdom started doing this as well, they arguably, without Japan's industrial foundation underneath it, they printed money, but they were not, the UK did not have an industrial foundation like Japan. Okay, Japan is not an isolated problem, but potentially it's the leading edge of a broader sovereign debt crisis. So here's where it becomes very critical for gold, very critical for XRP, very critical for everything. Japan's currently trapped in a defensive cycle. When the yen weakens, authorities defend it indirectly by selling foreign reserves, including U.S. treasuries. When Japanese bonds weaken, authorities step in to stabilize domestic yields by buying JGBs again. In other words, enormous amounts of liquidity are constantly being deployed simply to defend the currency and bond market simultaneously. It stabilizes the system temporarily, but it does very little to create growth, economic growth. It doesn't create genuine economic growth. Now imagine that dynamic appearing in the United States. Imagine a scenario where the U.S. bond market starts behaving more like Japan's treasury volatility accelerates. Could you imagine? Foreign demand weakens. The dollar begins experiencing confidence pressures similar to the yen. What happens to gold in that environment? Ladies and gentlemen, gold likely doesn't just rise. It reprices violently higher. This is not financial advice, just my opinion, retains any capacity. Because at that point, gold stops functioning merely as an inflation hedge. It becomes a hedge against sovereign credibility itself. And that's the underlying fear building beneath the surface of this macro conversation. Japan may not be the exception anymore. It may simply be the preview. So historically, these pressures emerged first in Japan, then spread towards the United Kingdom, then partially towards the U.S., and historically, policymakers have managed to contain the damage before it becomes systematic. I don't know, it's probably some magic how they do that. But every cycle requires larger interventions than the one before. That's why gold's story today is bigger than commodities. It's bigger than inflation. It's bigger than geopolitics alone. Increasingly, it's becoming a story about confidence in the architecture of sovereign debt itself. Ladies and gentlemen, if you want to understand what I just said, come and join the Crypto Public Test monthly. One tips from the pits can pay for your entire year subscription. Join over 560 other active traders and investors who have taken their own fine destiny in their hand. Ladies and gentlemen, this content is for informational and entertainment purposes only, should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves to never happen again, or you can be the one who saw behind the curve, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet right up until the moment they're not. And this is one of those moments. Do not blink because you're distracting the world with noise. While XRP continues to develop behind the scenes and building momentum in the broad digital landscape. Stay sharp, stay informed, accumulate knowledge, move now, be remembered. This is not the end of the story, this is just the beginning. This has opened your eyes, smash the like button, ring that bell, leave a comment with your thoughts. Turn on notifications, and more importantly, subscribe to the Crypto Public. We break down the major global banking trends shaping digital assets today, giving you content, clarity, and research you can use. Don't just watch this happen. Stay informed, stay ahead, stay in the public. I love you all. Enjoy Memorial Day.